Been a fun year so far. A lot of smiling faces out there. Everybody's so happy to be just throwing money at the sector left, right, and center. You know, I'm being a bit tongue-in-cheek. The truth of the matter is, this is a sector where, there's times when it's hard, and this is one of those times. It's a tough market for companies to finance. But if you're an investor and discriminating, that's actually a positive time, because as the guy on the other side of the transaction, you can get the best deals that way, as long as you're willing to be realistic and patient. And the truth of the matter is, you'll see this mentioned in a couple of my slides, companies that have, world-class or potential for world-class discoveries or deposits, and or companies that have new discoveries. The market's always there for those kind of companies. I mean, obviously in a raging bull market it's better, but you don't have to be in a raging bull market to find winners in this market. It's just a little more painful sometimes. Usual disclaimer. Basically, we're sort of in that time of year that everybody gets a little nervous on Wall Street and Bay Street. September and October have a reputation, and they've earned it. And you can see the market's getting a little more skittish, and really it's about, it's been about yields. Truth of the matter is, as this year has gone on, the bond market and equity traders, they've all been pushing back that, one, how high does the Fed go, and two, how long do they stay there? Honestly, I was a bit surprised at the reaction to the FOMC meeting Wednesday and yesterday. I've been in the higher for longer camp for a long time, pretty much since the start of the year, really. I didn't see any likelihood of the Fed cutting in 23. I'm not that sure they're going to cut in 24. It's just, but to me, that was out there months and months ago. How quick you think that's going to happen? How much you think it's going to cut? I mean, at the end of the day, it really comes down to, do you think there's going to be a recession near term in the U.S.? I'm not seeing signs of that personally. I don't think there will be one near term. That said, a lot of the best indicators for recession are generally pretty short-term ones. So by the time you really see them roll over, the recession is probably staring you in the face. So I'm not discounting the idea, but right now in the data, I just don't really see it. So what fixes things? Does anything fix things for gold or for base metals? Well, for gold, one of the things I find most interesting is that when you look at the backdrop, gold is actually doing really well. Honestly, gold should be trading a lot worse than it is. I know it doesn't feel that way. I know relative strength is probably like 11, but the truth of the matter is, when you look at the headwinds, US dollar rates, movement in the yield curve, gold should actually be trading a lot worse. And it tells me something positive that it isn't. We haven't had that event yet that really generates a rally. But honestly, I could look at the data that's out there right now and say gold should be 1,500 or 1,600, not 1,900. I'm not at all unhappy. It's trading at 1,900. It's actually doing pretty well. But, it all comes back to this, like it or not. If you see this move here, this is actually the bond market. So that's the forward yield curve. It's basically derived from actual bond trading prices day to day. The top one, this is the dot plots. And you can see there's 4 different dot plots here going back to the end of last year. You can see how much higher the dot plot from this week was. And that gap right there, that's what freaked everybody out. Because suddenly, it's not that they were necessarily talking about more rates. By the way, this is a 2024 dot plot, so this actually starts in January. Depending on how you read it, maybe there's another 25 basis points, maybe there isn't. But what really bugged people was that you get to the end of 24 and there's really no reduction in rates there. That's what moved these curves. This here is basically the forward yield curve derived from bond trading prices after the June meeting, the last set of dot plots. Here it is yesterday. Really large move there, and that's why equities were having a tough time yesterday, and why bonds were getting killed again yesterday. One thing, if you want something to kind of cheer you up a bit, I guess, if that's even the right phrase, keep in mind all of these dot plots and stuff. It's all guesswork, right? I mean, we can look at a dot plot right now and go, oh my God, rates are going to be 4%. The Fed fund rate is going to be 4% at the end of 2025. You know, throw in a couple of quarters of 1% growth, they'll start cutting like crazy. So, you know, this stuff is all just current estimates. This can all turn on a dime, and I guess, you know, I don't want to sound like I'm cheering for a recession, because I'm decidedly not. But, you know, if it makes you feel any better, there's always potential for this curve to shift down. I mean, all it takes is 1 weak quarter or some exogenous event. I don't think the ones that are staring us in the face right now, namely shutdown in Washington, restart of college loan payments next month, that kind of stuff, those will probably all be drags. I don't see any of them being big enough to change what the Fed's going to do. But if something happens and suddenly you go from a, you know, 2.5% annual growth to 1% or 0, they'll cut like crazy. So don't take any of this stuff as gospel. It's all FOMC members guessing. So when you take this out, you look at these 2-year charts. This is a very long chart. This shows the 10-year yield, which is kind of, U.S. 10-year yield is kind of the benchmark that everybody works off of. You can see this, I mean, this is a huge move. And you probably all heard the phrase, buy bonds, wear diamonds. And the reason for that phrase was because of this. 40 years of falling yields, that's basically a 40-year bond bull market. That bull market's done, dead, over. Probably never coming back again. And then if you look at a shorter time frame, basically over the last year, this is real interest rates, basically 5-year real rates. And to me, real rates, that's really the driver for the gold market. You know, not so much nominal rates, but real rates. And this is a big move. I mean, a year ago, real interest rate was -1%. Now it's over +2%. 3% in 1 year is a big, big move. And that's why I say, when I look at charts like this, I'm actually pleasantly surprised that gold's not trading worse. It could be doing a lot worse when you look at a couple of charts like this. This is just a monthly gold chart. And again, you can see during that period when rates were starting to get jacked up, because of course the inflation rate was rising at the same time, freaking everybody out, gold was going right along with it. It's kind of bottomed out now. I think there's fairly good likelihood that we'll see inflation tick up again through the end of the year. I'm not expecting anything dramatic, but you look at things like oil prices, you can already start seeing that feeding into things like airline tickets. You know, core inflation doesn't include energy prices, but energy prices do feed into a lot of things that are in core. So I wouldn't be shocked to see inflation tick up 0.5% or 1% over the next 3 or 4 months. If it does that, ironically, that's actually would be a positive for gold, because when you think about that previous chart where the real interest rate, I think, is a real driver, if yields don't move and inflation ticks up 0.5% or 1%, that takes real yields down. It's a positive for all commodities actually, but it's especially a positive for gold. And you know, I think when you look at the reasons for this, you know, we all know what some of the big ones are. Central banks have been very heavy buyers for a couple of years now. They're all trying to diversify their asset base a little bit and their reserve base, get a little bit out of the U.S. dollar. I'm not one of these guys who thinks the dollar's going to 0 and there's going to be a stampede or anything, but there's been quite a lot of central bank buying. That's helped quite a bit. The other thing that you'll probably all find hard to believe, the top chart here, this is central bank buying, quarterly buying. You can see how it ticked up, but this just goes to the summer. It's actually lifted up again in the last little while. This chart honestly shocked me, and I'm still not sure I believe it. This is a generalist chart. This is a poll that Gallup does once a year. It's a very simple poll. Basically asks investors to identify, gives them a choice of real estate, gold, stocks, savings accounts, bonds. You know, what do you think is the most reliable asset class that's got the best potential? And weirdly enough, you look back, you go from 22 to 23, that's gold in blue. Gold actually comes in second just after real estate. And given how real estate's doing, I kind of suspect if you did the poll again right now, those two would have crossed. And like I said, when I first saw this chart, I was like, get the hell out of here. Like, you know, everybody hates gold. This can't be wrong. But this is a very large survey Gallup does every year in the US. So obviously the idea of, I think gold is an inflation hedge. Bonds, people just like kind of go, gold's got no interest rate. True enough, fair enough. But, the problem with having an instrument with an interest rate that's tradable like a bond is that when those interest rates are going up, your bond is getting killed. So, like, yeah, if you bought 10-year bonds at the start of the year, you got 4% interest rate. Yippee, you got a 20% capital loss. So I think that's part of the reason why you've seen this shift. It's unusual. I really didn't expect to see gold come out that well. But again, I think that's part of the reason why gold isn't trading worse. It's the reason why it's in the mid-1900s, not the mid-1600s. And as far as my not really expecting a near-term recession, this is a chart I just came across, I don't know, last night, which I thought was it's quite interesting, actually. What this shows is the green and then the gray, these are fiscal flows. So you can think of it as essentially being government surplus, government deficit, how much money is going from the government being pumped into the economy at any given time. You won't be surprised to find out that U.S. government mainly has run deficits. So basically, the higher that is, the bigger the deficit. You're seeing this climb, and it's going to climb quite a bit more if the legislation that's been passed in the states in the last few months, like the Inflation Protection Act, the Build Back Whatever Act, the Infrastructure Acts, that's all more spending. The other part of this, and again, this is something that surprised me a bit. The pink line here, this is basically bank lending. So it's basically whether bank lending is advancing or contracting, because one, that's another source of money for companies, consumers, or whatever. It's also another addition to the money supply if you're a supply side inflationista. Both of these things are going up. I don't see, with the exception of something exogenous, I don't really see that. I don't see how that turns around quickly. So I'm not saying circumstances out there that to me would imply a near-term recession. People have been making noise about unemployment in the U.S. in the last little while, and again, I mean, this is COVID, so that part of the chart almost doesn't mean anything. This is weekly unemployment claims. Yeah, it climbed a bit through the summer. It's gone back down, and now it's around 200,000 a week. That is not a high number. That's a pretty low weekly unemployment claim number. So, if you're expecting unemployment to generate recessionary conditions, it's got a long way to go. I mean, you got to be up into 400, 500 before you're looking at anything that's I would call recessionary. Base metals, of course, somewhat different situation, obviously, than precious metals. Base metals are pro-cyclical. Basically means you want economic growth. Ideally, you want inflation. Copper is actually a great inflation hedge. It doesn't get credit for it, but it is. And the 900-pound gorilla for base metals for 30 years now has been China. This is a pretty current monthly reading, month to month. The red is consumer spending. For some reason, it didn't show up there. Retail sales, and this is industrial output. Are those numbers great? I mean, not really. No. I mean, they're kind of meh at best, but they're not negative. You can see this stuff has started lifting a little bit lately. I am not expecting a repeat of the 90s and the aughts. I don't see Xi throwing trillions and trillions of dollars at the property market. It's already absurdly overbuilt. They don't need more property. There'll be certain, there's certain infrastructure spending, but I think you'll see him mainly concentrate on consumer spending. I think, China realizes that to get to the next level in terms of income per person, they really need to start generating an internal consumer economy. So you're not going to see them smashing records every year for copper imports and stuff. That's, that cools things slightly for base metals, but, and this is a very big but, if you go back to my previous slide, a lot of that uplift that you're seeing in government spending and stuff in the U.S., it's dominated by infrastructure plans, green energy spending plans. In other words, stuff that uses things that hurt when you drop them on your foot. This is hard dollar spending, hard equipment spending, hydro lines, dams, batteries, all that stuff. Europe's the same way. I mean, that's most of the government spending is being focused there. So I think, and the other thing that we're getting in the U.S., the reshoring that started sort of during COVID, basically trying to bring industrial infrastructure back into the U.S., I think that's here to stay for political reasons. I mean, we've got past COVID, but China's government isn't exactly trusted, to put it mildly. So I think that reshoring and probably getting nastier about things like tariff is going to continue. So I think we'll see a bit of a shift over the next few years from China being the 900-pound gorilla that's like everything when it comes to base metals. I think you'll see regional usage of and demand of base metals start going back up again, probably at a quicker rate than economic growth in North America, in Europe, in South Central Asia, and India, basically anywhere but China. I think you're still going to see the demand, and quite strong demand for base metals through the end of this decade and beyond. It's just going to shift where that demand's coming from. So I'm not that spooked by the fact that China's looking like it's going to grow fairly slow for a while, because I think the demand's going to come in from other areas. So I'm not that worried about it. Just to give you the super quick, you look at copper. I mean, nickel's doing okay. These things have all seen pullbacks, and this is the China effect, with the exception of copper, which has got more grid usage. I think we haven't seen any of that, green energy, expanded grid, reshoring of factories. That's really just starting to kick in now. So I'm expecting prices to be decent for base metals and potentially really good, because as has been the case for decades, getting a mine permitted and built anywhere in the world is a very, very, very slow process. So you just can't flip a switch and make another 2 million tons a year of copper, 1.5 million tons of zinc up here. That just doesn't work. So I'm still pretty comfortable we're going to see enough demand growth that we should see, increasingly good prices going through the end of the decade. And this is just a, straight up summary. Like I said, gold's traded well. It's obviously not trading well enough to make us all happy or make generalists be drawn to the space. I mean, I think the relative strength right now for gold is like 11, which is pretty shitty. So it's definitely got some work to do. But I am encouraged by the fact that it's not trading a lot worse. And I know that's a backhanded compliment, but there you are. Jay said something interesting in his presser yesterday. He was asked, is a soft landing your base case? And he said, no, it's not our base case. And I think that's the other reason why markets didn't have a great day yesterday. And I don't think he was saying that because he isn't trying. I think he's hoping, he's got his fingers crossed for soft landing. But truth of the matter is, there really is no historic example where a central bank has raised interest rates this much and not created a hard landing. They're definitely trying to create a soft landing, but if you're just going to go by the odds, you're not going to expect a soft landing. And I gave Powell credit for being honest enough to say that yesterday. That doesn't mean he won't pull it off. He might. But, even though I'm saying I don't expect a near-term recession, what's happened with the yield curve is something that generally ends up creating a hard landing. It doesn't necessarily happen right away. It takes time for pressure to build up when interest rates are 5 or 6%, and this real estate developer goes under, that factory can't make money anymore, et cetera, et cetera. This stuff doesn't happen overnight. It takes time. But we may still have a hard landing. I just don't see anything right dead ahead in front of us. And the other issue, it feels to me, and I got no data for this. This is really just touchy-feely watching the market. I think Wall Street is pretty close to the point where it's going to have trouble dealing with swallowing yields much higher than now. And even if you think the Fed's not going to raise rates, and I don't know that they will raise them again. I mean, in their dot plots, there's room for one more increase, but it didn't sound like they even believe it themselves. As much as the Fed controls interest rates, and rates and yields are determined by the bond market. And a couple of things that we've got coming is, deficits, as far as the eye can see, they just keep getting bigger. There's a lot of bond issuance coming. Washington's got to sell a lot of bonds to pay for stuff. So just that issuance, plus concerns that you might see slightly higher inflation, it's not out of the question we'll see yields go up another, not the Fed fund rate, yields in the market. It's not out of the question they go up another 25, 50 basis points. And if that happens, that might be our trigger. I think Wall Street would have a bit of trouble dealing with that, honestly. And then, you know, I think, and like I said just before on the base metals, I think there's room, you know, I think there's room for gains on near-term gains on base metals if things play it the way I think, which is no near-term recession. Even if there's a bit of one, the long-term demand curve looks so good for base metals that I wouldn't be sweating the short-term moves that much. You look for great projects and great teams, and be willing to kind of stick around for the longer term. And the other thing, you know, that I want to stress, and the guys sitting to the left of me are a fairly good cross-section of the kind of companies that I follow, because to my mind, even in this kind of market, there's two types of companies that can do well. You know, ones that have very strong, hopefully world-class projects, and obviously a very good team to husband those resources and shepherd them through the development process and get the market to pay attention. And the other type of company is early stage companies that are basically explorers that make new discoveries. The market's always got time for a new discovery.